Maybe the stock market crash turned out to be a complete and utter lie. We all got joked into buying bonds and GICs and storing cash and high interest savings to make 4 or 5%, while we damn near missed out on the 25% rally from the October lows we've seen in the S&P 500. These crazy returns in the NASDAQ, to the point now where we have to discuss what is happening to the future of the market. Where does the real value lie? What do I think is going to happen moving forward? We got to talk about the data, of course, driving this market to the freaking moon and back. And if that is a conversation you'd appreciate, as I offer my full transparency, my opinions that aren't financial advice, because I'm one of the biggest clowns in the financial YouTube space, but damn it, I think I'm one of the best. Consider hitting that like button, because look at these stock charts. My God, if you weren't able to get in on some of this, you are just hating life, because the bull market never ended. It's like we took a few day hiccup, or a few days, more like a year and a half hiccup, back to the point now where they always say that when by the time the recession's announced, the stock market, is already priced it all in, and the stock market's going back to highs. You can't gamble on this crap. You just can't. You can't. This is another true time that timing the market is freaking impossible. It's all driven by inflation, folks. I mean, recently inflation data came out in the US. We're back down to nominal rates, which means likely we're going to see the end of interest rate hikes, except here in Canada. We did get another interest rate hike, but obviously this steam is coming to an end. Canada's now at 5% on the interest, and inflation can come down. It's a really two-edged sword, because politics and government can control inflation more than the Bank of Canada can, or the US Federal Reserve, because they just control the lever that says higher interest, lower interest, burn money, make money. That's the only thing they can do. But the government in Canada, especially with carbon tax and all these taxes, they could just cut a few taxes. They could levy some of that, bring inflation down whenever they wanted to. But hey, there's got to be some pain in the economy, and the economy is just not breaking. We can afford the pain. Is this the first soft landing we're ever going to see in history? Very likely, maybe potentially. It'd be a historic event, really. I mean, you look at housing, right? The higher the interest has gone, it's been not doing anything to the housing market. If you ask me, that I think, should housing have crashed? Yeah, I think it should have came down a lot more. Why isn't it? However, U.S. housing prices have been going up since January. Canada is really no different. Canada, what has been defined as a housing bubble for like a decade now, is still going up. I mean, we just recently saw a month-over-month increase in values. How is that happening? Well, inventory, right? Obviously, people that locked in 5-year rates or 3-year rates in 2020 and 2021, they don't even want to look at selling their house, because then they got to get another mortgage, higher rates, give up what they've worked so hard for. I mean, you take a look at new people like us that have been buying homes in Canada. They don't care about the rates, because they'll put higher deposits, because there's just nothing on the market, folks. There's no inventory out there anymore. Inventory is at like record lows, so people just don't care about the interest rates. It's not going to crash the market. If somebody's willing to sell their house because they can't afford the mortgage, someone's damn near there to buy it. It's just so unusual. You really thought we would have seen some kind of crazy crack in the market, whether it would have been employment, maybe unemployment just spike, crack that back, or maybe housing crack, destroy that part of the market's back, but it just didn't happen. It's not like '08. It's not like going back to the 80s, 90s, 70s, whatever. It's just so unusual what we are seeing here, folks, which is why you can't predict it. It's why we're trying to get in the housing market. We're working on this deal. It's why I'm still buying stocks. It's why I'm never sideline, ever. I will never sideline. I may do some adjustments, put myself where I feel comfortable, but you don't sit on the sidelines, or you lose. What's the saying that, bears sound smart, but bulls make money? That's what we're seeing right now here, folks. So let's talk about the bulls making money. Let's talk about where the money's going from here, what I think is going to happen in the latter half of the year. Firstly, the volatility index is getting this descending wedge, as the crazy chart drawers and day traders like to call it, even though I think it's all fugazi. Obviously, we are seeing post-pandemic level volatility in the market, and this has crushed all the shorts. Everyone's just cost averaging these money market funds. They don't want to miss out. Momentum, AI, trading, everything is just buying right now, and they're all buying the top weighted S&P 500 companies, which is leading to some fear amongst many hedges out there. A lot of people are like, you know what, time to take a breath. A lot of people are like, I'm done buying this crap. I want to take a breath here, because when you look at the top weighting in the S&P 500, I mean, you're talking about your Apples, your Microsofts, your Amazons, Nvidias. I mean, most of these are pushing all-time highs, or are over all-time highs with Apple and Nvidia, Microsoft. I mean, even Meta's back over 300 now. Tesla's up here. Everything's crushing. Nonetheless, the fear of all of this momentum has drove the QQQ ETF that represents the NASDAQ 100 to do a historic reweighting. For the first time in a long time, they're calling it the Historic Magnificent 7 Rebalance. The top weightings in the QQQ ETF have driven all the performance, but to the point now where they're like, hey, let's do the responsible thing, which I always tell you guys when you make a lot of money in short periods of time. you do some rebalancing, and they want to take the whopping 46 to 48% weighting these top 7 companies make and reduce them down to about 38.5, which I think is actually a really smart, intelligent thing to do. I think this is going to benefit them. Will it remove some of the growth potential? Yes, but who thinks all the growth potential is going to remain in these top 10 companies? Personally, I don't. I could be wrong, but what I think is going to happen is upcoming earnings, looking at things like Tesla stock that's coming up very shortly, for example, in the next month. I mean, you're talking about companies that have been doing everything they can to increase gross profit, not revenue. I mean, Tesla's been cutting costs like crazy. They've been lowering the price of their vehicles. They're saying, hey, we don't care about margins anymore. We just need to get the cars out there. And that's going to affect their gross margin and their earnings per share. You look at companies like Apple, where the revenues have fallen off. Google's been trying to fight and get rid of ad block to start increasing ad revenue. You look at things like Netflix. Netflix obviously stopped password sharing. That worked to their favor. Companies are laying people off. They're doing what they can to bring gross margin up. We're out of a growth phase because, unfortunately, higher interest rates, they're like weights on the market. They pull everything down with them. Luckily, the economy is still proving extremely resilient, and these companies, they are trading at higher values. That doesn't mean they're going to drop off on earnings. We could see a flat line into the end of the year, but where do I think the value sits? It's on the lower half of the S&P. Everyone keeps talking about these top 7, 10 companies driving the market. Where they should be paying attention is these stocks that aren't driving the market right now, the lower weighted S&P 500. If you're looking for individual value, let me point it out. Find the stocks that have been unjustly just slaughtered or hit really hard because of the interest rates or because of housing or because of some factor that people have turned away from it. Look at Home Depot, for example. Home Depot is trading 20-30% off its highs still, and it's paying a healthy dividend, and its PE multiple is well below market value. I mean, the S&P is trading well over 20 again, right? So you could look at things like Home Depot, the bank stocks. I mean, look at JP Morgan. A lot of these banks, they just got the audited approval to increase their dividends, to do share buybacks again, because people are like, hey, you know what? Your banking is not that bad. Your system's pretty good. You guys put loan loss provisions aside. You got enough to cover any faulty debt. You guys do what you got to do. And a lot of these banks are hitting all-time high revenues, right? Even though they're not seeing it hit their EPS. That's why they've been hit so hard. But JP Morgan's been rallying over the last few days. Warren Buffett, I think, unjustly sold these at the wrong time. He sold out of his banks. He didn't like the banks. I don't know why. Look at Bank of America. Even though this one hasn't recovered yet, I still think these are very favorably valued places to be buying because the market hasn't given them the momentum that it's given to these top weighted tech companies. And eventually, when people get bored and exhausted of the momentum and the overvaluations, they're going to start driving some of that money back down here. And I think that's what could potentially take the market back to a new all-time high. Look at TD Bank. I mean, I've been buying the banks. They're like Pokemon cards, collect them all, buying up a lot of the Canadian banks because, again, TD, Royal Bank hitting record revenues, not showing it on EPS because of writing down loan loss provisions and stuff. But that's going to come to an inevitable end. If this is a soft landing, things normalize, the real estate market stays strong, this is going to come to an end. And eventually that record revenue is going to hit a bottom line EPS. These stocks are going to rally back. They're going to take the market back up with them. So you have a few options here, right? I mean, you could even look at things if you're really digging into the healthcare sector. I mean, Pfizer's been just getting slaughtered ever since, the lack of the vaccine stuff. I mean, there's just so much value out there that people get fixated on a few companies. I don't know why. But look at some small caps. Look at these companies. Keep cost averaging the S&P. Don't listen to the insanity that I've always been telling you. You can't sideline this crap. You just can't. I've always, I've become a little bit more conservative in my nature during the market volatility. But if there's something you need to be aware of, I've always been in the market. I mean, we bought the S&P at the best time. I've told you guys in the October area, any of these dips. If you go back, watch my videos from October, and I said every dip the S&P takes, buy every dip that's out there. Just keep buying. I threw $10,000 in the S&P sometime in October. We kept buying when it pulled back here. We bought it. I've done nothing but load up down here. So we're seeing that benefit. It's allowed me to buy real estate. It's allowed me to do these things. And you remember, don't ever sideline the market. Cost averaging, bulls will always win over the long term. But as always, I'll pass that question off to you. Do you really think that the soft landing is here? Do you think this is going to be the new bull market? Or do you think we're overvalued and it's going to come to an adjusting end? I'd love to know what you think down below.